Hey everyone, hope you're well, hope you've had a great week, and today I wanted to go over some changes in my portfolio over the last week and also some recent news that's come out around some of the stocks I hold which may be of interest to you. Hey guys, sorry to interrupt, Future Ben here. I just wanted to take the time to apologise for the odd intermittent noise coming across my microphone in this video and also highlight a slight difference in the actual lighting of the video. Please let me know if you like it or if you prefer the slightly lighter version as normal, and I will let you get back to the video. Remember to like, subscribe and comment below, and hope you have fun. So, without further ado, let's look into some of the recent news around some of the stocks that I currently own. So, first of all, we've got a report from 3M, the title being 3M stock is unloved and underpriced. Here's why it could shoot up higher. It's an interesting read, and I have linked some of the details below for you to have a look into. However, generally, it is stating that the actual area of industries has been going up, but doesn't seem to have been getting much love from the investors. There is a quote from Capital Economics. This is, with domestic goods deemed still elevated, inventory levels still looking very lean, and the dollar weakening, the immediate outlook for this sector remains upbeat. Buybacks are going to be unlikely given the optics of repurchasing shares during the pandemic and obviously the knock-on effect from the pandemic. And companies are more likely to fund their capital spending in research and development areas as opposed to buying back shares for shareholder inflation. I don't see this as a bad thing. I would personally prefer companies to pay out their dividends and then invest spare capital into their company rather than arrange share buybacks. They have also highlighted a risk for 3M due to past use of certain chemicals in 2000, and they feel that there may be repercussions from this due to water contamination. So I would keep an eye out for that and see if anything comes along, as that might inflect the share price in a negative way. They also point out there has been a steady decrease in the share price since 2018. However, this has recently started to take back up, and they're hoping that it may break out and come to new values. For the last line of the report, they've said, if 3M can break through the resistance, it could trade as high as $210, which is a 27% rise from Friday's close of just over $165. So now we move on to AbbVie. They've had a recent report come out about how they have managed to avoid a massive tax bill to the Irish. Essentially, they have won a victory against the revenue commissions after the Tax Appeals Commission did determine that the company cannot be hit with the €572 million tax bill. This is in relation to the acquisition of Allergan last year, which was a £63 billion deal. This has been formed from a recent introduction of a measure in 2019 by the government, where they've tried to charge LPC stamp duty for the acquisition and would have then amounted to a total tax bill of €572 million. So that's a bit of good news for AbbVie and their investors. However, potentially not as much for those who feel that companies already skate the sides of paying tax to the government. So for any of you Apple lovers, we have got a little bit of news on Apple. There is a lot flying around at the moment, but one story that really interested me is the following. The title reads, Apple's new 14-inch MacBook Pro to bring back MagSafe and plentiful ports and drop the touch bar. Looking through the report, it seems that Apple are actually updating their recent MacBook Pro, which is nice because a lot of their products don't seem to have changed over the recent years. And the changes they have made generally seems to get a bit of flack because they're removing features that people actually want and then adding features that people don't. I personally am not affected by this. I'm more of an Android and Microsoft user as opposed to an Apple user. However, I feel this increase of functions to their equipment that customers actually want is a good direction rather than telling them what they would like. It is also expected that the new PCs will be running on the Apple Silicon, which is a bit of a bite to Intel. And there also seems to be rumours that they will also be adding in graphics cards from Apple Silicon, which can go up in different variations of rate. Currently, they seem to be testing the M series processors with 16 and 32 cores, with a prospect to move up to 64 or even 128 graphics cores in 2022. Now, with Apple Silicon, I'm quite torn. I do like the idea of Apple taking this in-house and building it up themselves rather than relying on external companies where they just tweak the software. However, this does have the added disadvantage of tying you even more into Apple's ecosystem, which, while itself is a good marketing technique, I'm not personally a fan of. So we've also got a brief update for AXA. This essentially is just a price breakdown. There have been several analysts that have reported this according to the report. However, Jefferies Financial Group analysts have set a price target of €26 for AXA going forward, and they have marked it as a consensus of buy rating at the price of €22.93, which is $26.98. So that's a bit of good news for anyone that is currently investing in AXA or anyone that was looking to invest. It does give you a bit of a price guide there. So we also have Bank of America, who seem to have been hit with a class action lawsuit for failing to prevent fraudsters and looters essentially from stealing money from debit cards. So the charges being levied against them is that they did not take the effective actions to secure their EDD cards. These are used by struggling workers, and they didn't put anything in such as chip protection or chip technology to prevent any issues. When users got in contact with Bank of America to try and resolve this, they essentially got put on an endless hold loop and never got resolved, or submitted their claim to have been told that it was already sorted and that they never got their payback. It doesn't actually state what the amount of money across all of the accounts that's been taken is, so we're not actually sure on what a possible settlement could be at the moment. However, it's worth keeping an eye out to see if anything happens in the future. A bit of good news for Cisco Systems, as they have been named the top socially responsible dividend stock from the Dividend Channel. They state that this is a stock with above average dividend rank statistics, including a strong 3.2% yield, as well as being recognised by prominent asset managers as being socially responsible investments. It also goes on to highlight what ETFs Cisco is currently held in, and also to cover the dividend, which currently is at $1.44 a share and is currently paid quarterly, and the most recent dividend going ex on the 4th of January 2021. Next for GSK, we've got a report from Income Investors, the title being a high yield stock you likely haven't considered. So I already invest in GSK, and I am looking to pick up more shares as time goes on. However, from the report, it says that you could earn up to a 5.8% yield on this healthcare stock. They say that it's highly attractive due to the price and the fact that it does have a high yield over the stock price at the moment compared to its other competitors. They have highlighted that since the drop-off of a lot of stocks at the beginning of the year, GSK hasn't rebounded the same as a lot of the US stocks. This does go generally across most of the US and UK market, to be honest. The US market seems to have rebounded quite well, and the UK market hasn't. I don't know if that's just because there are more investors that look into the US market. However, there are a few good deals in the UK market that might be worth picking up. However, if you are a US investor or trader, you would have to account for the currency fluctuations between pounds and dollars. I feel mainly with GSK that they're a stable enough company to hold. However, if they could break through anything in the vaccine industry, especially around COVID, that would probably give them a high boost. We've also got a report about JP Morgan. So JP Morgan and Chase on Friday have made the following announcements. JP Morgan Chase reported Friday a jump in fourth quarter profits on strength in investment banking and some customer lending businesses as it releases some of reserves taken earlier in the year in this pandemic. JP Morgan Chase managed to report quarterly profits of 12.1 billion, which is up 42% from the last year's levels. This also includes a revenue increase by 3.3% to 29.2 billion. Chief Executive Jamie Dimon has said that the reserve release reflects positive vaccine and stimulus developments, but adds the bank still has 30 billion in credit reserves in case things take a turn for the worse. So that's a bit of good news for JPM. They've managed to increase their revenues while still having a buffer around if needed in the event of another downturn. And Royal Dutch Shell seems to have been awarded a buy rating from Credit Suisse Group, which is interesting for an oil company, as a lot of people seem to be steering away from them due to the innovation needed in the area to greener technology. However, I personally have picked up a couple of shares and may pick up some more in the future. And then just a brief one about Royal Mail. Royal Mail has appointed a new chief executive. They have appointed Simon Thompson. I don't know much about Simon Thompson. I've looked through the report to see what I can find. He did work on the NHS test and trace system, and as far as I was aware, that was an abysmal fail. So I hope that that was a one-off and he didn't drive that forward so much. And under his guidance, Royal Mail will prove a lot better than the NHS test and trace system. Right, so that's a brief snippet of a load of information I've seen about companies I hold and potentially some that you may hold. I have added links below for all of the documents I've looked through so you can go and do your deeper research. I didn't really want to make this video just me reading it all off, so I've just picked out some highlights, and if anything interests you, feel free to go and check it out in a bit more depth. Thanks for sticking with me, and now I just wanted to go through quickly an update on my portfolio and what's changed from last week to this week. So moving into Trading 212 and looking at my ISA, you can see that my current portfolio value is £2,019.79p. As you can see from my changes from last week to this week, I have had a slight decrease from 2031 value all the way down to 2019. Personally, this doesn't bother me. I'm still in the green, and as I don't plan on selling any of my shares anytime soon, that's not exactly an issue for me. Moving over to the history of the app, we can see that I have had a couple of dividends. We can see that I've had a few dividends come in and a total return over my portfolio life of £22.14 in dividends. And as recent orders, you can see that I've recently picked up some CVS Health and Omega Healthcare. They are due to pay their dividends shortly, so I wanted to pick up some more before that happens. And an overall total return of 55.78. That includes selling some of my growth shares that I have picked up. So that's it on the portfolio front. Not much change and not much purchases. I am looking to pick up some more of CVS Health as funds become available. But overall, you can see that there is a general green pattern in the stocks that I've picked. You can see that I am having an issue with FX. This is because a lot of my stocks are American, and unfortunately you keep printing stimulus money, which is devaluing your currency. I appreciate that it helps your economy, but if you could please stop, that would help me greatly. So that's a brief update on my portfolio and the changes from last week to this week. So slight loss in value, however, I have managed to accrue some dividends, so I'm not as bothered. As I've mentioned before, my primary strategy is dividend investing. I'm not so fast on the gains and losses of my portfolio. To be honest, I kind of prefer it when it's in the red, as that means I can pick up more stocks for cheaper. But seeing it green does show that at least I haven't lost any money, and I'm happy with that. So thank you for your time and thank you for watching. If you have any questions or any information you'd like to share, please drop it below. I always like to read the comments and I will always reply. As always, I'm trying to make these videos better and improve as time goes on. So if there's anything you've seen that I can do to improve or increase viewership that you feel may be useful, please do add below and we can have a talk about it. If you want, I can be more flamboyant and do more things. However, I'm not sure how keen people will be on that. However, I'm always happy to give it a go. So if you want a more flamboyant Ben, just let me know below. Have a good rest of the week. Bye.